committee decided to increase the monetary policy rate by 50 basis points to 14.5%. The underlying reason for doing this is to steer inflation back to the 6 to 8% target band, which is the medium-term objective, and help anchor inflation expectations, which we have observed have been persistently or are persisting to be above this target band. Now, to give you more color on what really is going in the inflation space, I'll now look at the inflation out 10. What we note is that in the fourth quarter of 2024, average inflation rose to 16.3% from 15.5% in the third quarter. We'll see this when the connection comes up. We have a table which has the details on these developments. Implementation of higher emergency electricity tariffs in November 2024, triggered by the drought in the 2023-2024 rainy season, has had a substantial impact, particularly on non-food inflation, which rose to 14.1% from 12.2% in October. Now, here I think it is important to indicate that we don't quite react to the administrative adjustment to these prices. But what we look at is what are the secondary effects of that. That's why you see that non-food inflation, is so impacted. So that's what we look at and try to moderate the impact from that adjustment. So with the connection now back up, although partially, I can go and show you this table. This is the usual table we share with you, which is in two parts. The first part is showing the average movements in inflation on a quarterly. These are annual figures, but done on a quarterly basis. Then we have end of period segment in the bottom of the table. So if you look at the top part of the table, the first row after the dates that are indicated there, you see that the overall inflation has risen to 16.3% in the fourth quarter from the 15.5% in the third quarter. So what is of greater importance is to see that this is a trend which is going up, and that's a concern. And I think this also become clear when we come to the second segment of our conversation this morning. When we break down into food and non-food inflation, you see that the food inflation has risen to 18.3% from 17.6%. Equally, non-food inflation has gone up, as I already indicated, from 12.5% to 13.5%. When we look at the end period numbers, this is for the quarter as a whole, we see that in the fourth quarter, inflation ended at 16.7 compared to 15.6. But it is important to point out here that whereas we ended the quarter at 16.7, we have started the new year at the same level. So this is an important marker which we are looking at very, very closely. And part of the reason why we are taking the action that we are taking is to try and hold that with a view that let that be the peak for inflation so that we can begin to move to lower levels of inflation. Now, when we break the same into the categories of food and non-food, again, there you note that food was at 18.6%, whereas non-food was at 14.2%, both of which were higher than in the previous period. But of significance is, if you look at what I said at the beginning, is that non-food moved up quite significantly because of this adjustment in the non-tariff. So you see that it moved by almost 2 percentage points during this period. So that's what we are concerned about. Now, when we drill down to the components of these categories, this chart, that if you look on the left-hand side of the screen, now what's happening? Why? So on the screen it is, okay, it has come. Yeah, if you look closely on the left-hand side of that chart, the screen, you note the blue, the deep blue coloring, the last bar there. You see that the blue is much, much magnified. That's the impact that we are talking about, which has pushed the non-food up. The others are kind of responding to that, but not to the same magnitude. So you have chance to look at that more closely. And when we look at the right-hand side of the screen, this is where we are showing what overall food inflation has been. You see in both cases, this is rising. Now, in the case of food, you see that bread and cereals came down somewhat, but then fish went up. And then you see also vegetables. So those were the two main categories, which food groups, that pushed inflation up. I think we have said something about vegetables in the past. I think this is a reflection of us not growing as much vegetables as we used to do, and that is having an effect on our food a basket. Now, to move further, now when we look at the projection of inflation over the quarters, we see that this is also projected to remain outside the target band. It is actually expected to average 14.6% in 2025 compared to 13.9% that we reported in November. Now, the relatively higher profile for 2025 is largely influenced by the recent increase in inflation and the persistent depreciation of the exchange rate. But maybe before I move on to that, let me show you this chart and the table. What we have on the chart, these are projections. If you look at the chart on the left there, the red dotted line is showing what our forecast was in November last year, that is last quarter when we met. But this time around, when we met, this is what the blue dotted line shows. It shows that actually the profile has changed, meaning that it's moving away from coming down quickly. But in both cases, there is a downward movement. But that downward movement is sluggish, such that in the current forecast, we see that it's not coming down into the target band. And that's the reason why we feel we need to do something to steer it back to this. The brown bar there is shaded part is showing where we ought to be. It's not tomorrow or the day after or the next day, but we must be moving towards this in the medium term. That's the target we have given to us in the budget. So when we look at numbers, this is what we see on the right-hand side, that for the year 2025, the average inflation will be about 14.6. That still is above the thing. Yes, in 2026, we see that this is going to come down, but it's still above the target band that we are looking at. Now, in the November projection, that's why this difference is appearing there. We had forecast that inflation would be 13.9 in 2025 and 9% in 2026. But there's a caveat there in that we were for 2026 measuring for 3 quarters, because at the point where we were, the 8 quarters were going to end in the 3rd quarter of 2026. So the 10.6 is in a sense not a good comparison to that, because this is for the entire 4 quarters of the year. But you get the gist that in both cases it's going down, but in the present circumstance it's still a bit more elevated, and that's what is informing us to take a look and do something about that. Now, the other very fundamental point to stress is that we undertake some surveys to gauge the players, the economic agents' perception of what inflation is going to be over the coming period. And what we have observed, this is what we are saying, survey data, which you can access through that reference on our website, is showing that the expectations of those that we survey is that inflation will persist to be above that. Now, why should we worry about that? We worry about that because if the expectation of you as an agent is that something is going to happen, it tends also to mold your behavior in terms of what you want to do or will do. So if the expectation is that prices are going to continue to rise, that means now you factor that into your operations. And that is not very helpful for us to bring inflation down. So we need to change that perception for people to feel that, yes, inflation is going to come down, and then be motivated to do better in the period ahead. So that's one of the key reasons why we thought that it was important to taper that kind of perception, because it's not helpful in the long run to our objective of getting inflation down. So we are also saying that when we look ahead from where we are, it's gratifying to see that actually, whereas previously the balance was that of risks, that is, was tilted to the upside. What do we mean by that? In previous projections, or when we looked at the future, it was showing that there were more risks for inflation to go up. But this time around, we see the opposite. We see that actually there are chances that inflation will come down. So that's why we have to adjust that feeling that inflation will continue to go up. But why do we feel this? Well, we note that the rainfall pattern has been much better this year than it was last year. So there is a high likelihood that would get some good harvest, which obviously will have an effect, a positive effect, that is on prices of food items. Now, even in the case of the power, we expect that there will be some adjustment, notwithstanding that the tariffs for these emergency tariffs have been extended for another period. But I think it's important also to see the stability of supply. It's not just an issue of the tariffs being raised, but it's really the availability of what you are paying for. So our sense is that things in that space are likely to improve, which means that that focus that we have made there could actually come down. So that has also an impact on the magnitude of the change that we had to consider for adjusting the policy rate. So, but we are also alive to, I think, as Mr. Tembo Jr. indicated at the beginning of this session, there are evolving things on the global scene. There are all these trade wars that could arise. So this is likely to have an effect, most importantly, on the value of our kwacha versus other currencies, notably the US dollar. So we have to start making preparations in how we respond to those developments. There are also heightened geopolitical tensions. These have consequences on what happens everywhere. So we say that those risks are there, but the domestic side, or in terms of risks, we see those to be weighted more towards positive outcome. So it's a question of how the balance will turn out to be. Then now let me move to the other market, which creates a lot of pressure on inflation in our country. In the fourth quarter, we note that the kwacha depreciated against the US dollars by rising to 4.5% from 1.7% in the third quarter. So that chart is right there on it. Will be policy adjustments, say in the US, in Europe. It means that there will be now a round of hikes of policy rates in those countries. And when that happens, then we see ourselves seeing reversal of capital flows and the depreciation in our currencies. So this is why I think the core for us to really ramp up the production and export of what we produce is extremely important. Moving along, we see that the main source of supply in the market continue to be the mining sector, which supplied $60.1 million as compared to which brought the total supply to $526.2 million in the period that we are looking at. So this was driven to a large extent by observed rising production in the mining sector. But of this amount, commercial banks absorbed $239.7 million. This was a little higher than what was in the previous quarter. In the previous quarter, they took up $232 million. But the net purchases from the sector was $286.5 million, which was remitted to the Bank of Zambia. That reflected an increase from the previous amount of $233.9 million. So we give those on the right side in the chart there, which will show you those pounds. But what we are saying is that on a net basis, market support by the bank declined to $197.8 million from $230.8 million. So what people might ask, why is this? Well, we have other obligations that we need to observe or meet. Notable in this regard is obviously the net international reserves that we have to meet in order to get the review program to move forward. And indeed, we had last year the IMF conclude the fourth review of our ECF arrangement. So this then helped us in a way to also build, because with that conclusion, we had some inflows that were enabled. Now, what we are saying is that because supply is not continuous, it's intermittent, what we see that this affects the activity in the interbank market. In other words, for the market to remain vibrant, you need continuous supply. Not today you have something, tomorrow you don't have something. That affects the operations of the market. So what you see in the chart, there are 6. You see that disparity coming out very clearly. Whereas you see in the third quarter, we had $324.4 million. In the fourth quarter, see how much went through the market. So this is what we are saying, that there was less activity because the supply was not as huge. Now, another variable that we look at closely is the demand pipeline, because that gives you a sense on what direction things could go. And we see that outstanding demand for foreign exchange rose to a high of $52.7 million, occasioned by the inflows we had from the World Bank, the African Development Bank, and of course the IMF following the conclusion of the fourth review of the ECF. It's important here to understand that the ECF, or the fund program, is catalytic to other players. If we don't have that positive conclusion of the review, these flows do not come as well. So that's the linkage that must be understood very clearly. In the fourth quarter of last year, our gold purchases amounted to $7.9 million, which brought the total holdings of gold to $225.1 million since we started this program in December 2020. Now, credit developments, on the other hand, were not as encouraging, as overall credit growth slowed down to 5.4% year on year in December 2024. So in the previous quarter, it had gone to 11.8%. So these are figures that are concerning, because given where we are in terms of growth, we are not hitting the levels that we would like to see happening. then you might ask, but why are you raising the policy rate? I think in anticipating that question, the reason is that inflation is omnipresent enemy that we have. If we don't deal with inflation, it erodes many things. So even credit, the quality of credit would be much better if inflation is low and stable. So with high inflation, it quickly eats into that space, which is not very good. So what we are saying is that over the same period, private sector credit growth reduced further to 20.7% from 29%. These are nominal figures, by the way, but the direction is clear that it is lower overall and in terms of the private sector. What we also not import here is that lending to government through government securities also reduced. This is very important. Why? Because all along, I think we have been saying there must be fiscal consolidation. Why do we want that fiscal consolidation? We want that fiscal consolidation so that there is less crowding out of the government-private sector. So with the government managing its affairs well, then its recourse to the market is reduced, which means that the banks and financial institutions then would have to go to their traditional ways of making money, which is lending. So as we have shared previously, we are still concerned that the lending, the deposit to lending, the loans to deposit ratio is low, which means that there is not as much intermediation. So we'd like to see a lot more activity in that space, because that's what is going to grow the economy on a sustainable basis. So just to give you the amount of government securities that are outstanding is 229.37 billion kwacha as at end December 2024. Out of this amount, the non-resident holdings stood at 57.64 million or 25.1%. Now, there is an issue here which we have highlighted previously, that as part of the debt restructuring process, we had to put a cap on non-resident investments in our domestic market. So this has hit us to a large extent, because when these flows come, they contribute in two main ways. One is through the inflow of foreign exchange, because we conduct the auctions of our government securities in kwacha. So they have to convert whatever foreign currency they have into kwacha to be able to participate. So that augments the supply of foreign exchange. The other aspect is to do with the price, which is the interest rates or the use on government securities. What happens? That means they kind of up the competition in that space. Now, because of this cap, this is not have already seen in a different fora, the town hall conversation, and also in the ECF fourth review. However, and that's an important however, because we expect that in 2025, growth will rebound. This is consistent across all the forecasters, that there is an expected rebound in a growth of our economy. So the idea is that we must be ready to really partake in that. And some of the drivers there are in agriculture, energy. This is why we are also putting our mouth where money is by the SRF, which we introduced to try and mitigate some of the impact of the drought. While at the SRF, I should also indicate, in anticipation of a question from you colleagues here, that how does this fit in with the SRF? Well, we insulated the SRF to a very big degree that when we make the decision that we are making, as we have done, this should not translate in the adjustment of the lending rate for those who have already borrowed. So that is important, because if we do not do that, then we are held hostage to that arrangement. So we manage this very closely so that we don't send signals that will impair its uptake. Again, the other point is that there's a cap of 10 percentage point, which means that relative to other sources of financing is to still be much lower. So we are wrestling with the banks to see that there is increased uptake of this facility in the period ahead, which would help to moderate the impact of drought, and more importantly, because the focus is on agriculture and energy, we could contribute to the food basket. So this is the end of the presentation. Just to reiterate that given that inflation remains higher than the target band, we have had to raise the policy rate, and more so that inflation expectations remain elevated. We think it's important that we anchor those expectations so that inflation can begin to move in the right direction.